Well, welcome everyone. Wait just a minute or two. We've got about 110, 115 or something joining today, so never thought Charitable Annuity Reinsurance would be so exciting, but I'm glad that it is. So we'll wait just a minute or two before we get started. I do want to, there are no snacks. I don't know who put that in there. We're already giving away this away for free, so we could do maybe virtual snacks. I think in Zoom, don't they have little coffee cups or who knows, potato chips or something else. If they don't have that, by the way, Aaron, you might want to create a new business of these maybe snack-a-cons or something, and you can make a couple $1 million doing it that way. So slides, I'll talk about that here in a moment. What I'm going to go ahead and do while we're waiting for others to join is I'm going to share my screen. And always important that everybody can see my screen and hear me. And so if you guys don't mind, if you could maybe just raise your hands to let me know that you can see. Oh, good, good. Okay. Always the most stressful part of any webinar, that they can hear the speaker and see the screen. Okay, I'm going to go ahead and lower everybody's hands here. Thank you, thank you. So I'll mention the slides maybe to start. Oh, it looks like Aaron's chat just came to me in terms of are there snacks. So I thought that went to all attendees too. You guys might have thought I was a little bit crazy there, but okay. We'll talk about slides and the housekeeping notes. Let's see. All right. That is functioning well. All right, I think we've got the mini herd. I think a few more will be coming in. So a couple housekeeping notes. Already had the one question through the chat. So we do not send the slides out. We've had some, we'll say, nefarious uses of our slides, but we do provide a full recording for free, and we post that on the CharitableSolutionsLLC.com website under Resources and Webinars. We have maybe 15 past monthly webinars on there, many as or even more riveting than this topic I would submit. So that is free. I have had a couple people say, well, what do you mean if you post that for free? Can't they just copy those? They can, but I've found in life that takes effort, and sometimes people don't choose to do that versus me just sending out the slides. We've had this happen twice where people have used the slides for purposes that otherwise I did not approve. So with that, always fun, a few people messing it up for others. We do provide, again, the full recording for free. So sorry about that, but hopefully that will still be helpful. And the way that the recording is set up, like most, is you can sort of easily scroll forward or scroll back or hit particular points or topics. You don't have to listen to the whole thing again like sometimes the recorded shows on our televisions work, sort of forcing you to watch the commercials. So we'll jump right into our commercial. Charitable Gift Annuity Reinsurance, when it works, what it is, what it isn't, when it works, and when it doesn't. So I am Brian Klontz, President and Founder of Charitable Solutions. I've been a little bit OCD in this space, frankly, since the late 90s. I am almost positive written every published paper on this topic since literally 1997. And so this will be a very much summarized version, which I think everybody will be very pleased to know, of some of that past research. So as I mentioned, this is free, which means you've got to sit through a little mini commercial. So I'll keep this to 4 minutes or less. You guys can get coffee or whatever. But we do have a number of clients in a particular area, and they would say, we've been with you guys, 10, 15 years, and we had no idea you did this other stuff. So frankly, shame on me. And so this is a sort of level setting of all the weird things that we do. So I'll go through it pretty quickly. So I'll go maybe left to right. So first, it's Charitable Solutions. Again, it's the firm I set up in 2003. We exist to help make gifts happen that otherwise wouldn't, period. That is our mission. And so there's a team of 16 of us who do nothing but that in very, very esoteric ways, primarily around risk management. And so we focus in two primary areas. One is on the non-cash asset receipt and disposition side, and the second is on what we're going to talk about today, on the gift annuity side. So what we always say is those are the only two types of gifts where the charity can actually lose more money than the original donation. So we have spent my entire career really focused on these two areas and sort of built out some very esoteric, very weird, frankly, service niches in these particular areas, all about helping gifts happen that otherwise wouldn't. So with that, I will jump up. Non-cash asset risk management. It's primarily what we do, probably 60%-ish of our time and effort. And so the primary way that we do that is we operate and created a donor-advised fund, a national donor-advised fund, that strangely does nothing but take in illiquid gifts, otherwise are risky sort of gifts, and that otherwise would have been declined by the charity that was it was being offered to begin with. So you can see there we've done about $1.6 billion. Here's my pointer, $1.6 billion of donations through the foundation, 100% of which was initially declined. Tons of real estate, tons of privately held business interest, doing a lot of crypto recently, a lot of crypto. So any kind of illiquid gift, we're doing very strangely a number of cannabis gifts that otherwise by policy the charities were not comfortable taking in, doing those on the Canadian exchange, do foreign property. Anything you can imagine, probably we've done. Sculpture of the Bull on Wall Street. So artwork, oil and gas, tons of S-Corp stocks. We have a UBIT structure for mitigation there. Bottom line is if you ever have a donor or you have a client, number of advisors on the phone call today, that is trying to make a gift, what we always say is a good donor with a good asset wanting to do good things, and for whatever reason, if that charity is not able or comfortable or it's a super quick turn in terms of the time constraint, then do not decline the gift. Rather than doing that, referring that back over to us, we have a number of evil competitors, and we all talk, and they're all great. And so there might be other facilitating charities that might be able to help take that in as a donor-advised fund, all the same best practices. Then the donors can recommend the final grant we send out 31 days after settlement to the charity or charities that the donor was trying to give to in the first place. So it's a giant pass-through for these illiquid type gifts. Average gift last year was 3.8 million was the average gift. We did 99 of them, could not make it to 100. You have no idea how much that pains me. You have no idea. The average fee on that was 1.6%. So it was about $383 million came in, 1.6% fee, 98.5 cents on the dollar in cash granted out. So we do all the sausage-making stuff, and then the final cash is going out, again, to the charity or charities the donor was trying to give to. Second is a gift annuity. So we have this similar structure, an entirely different charity called the National Gift Annuity Foundation. You can see there we are in 49 states, everywhere but Hawaii, and have this same model. We take on the risk. We issue the contract. We manage the liability, and then 100% of the residuum is paid back to the charity or charities that the donor, again, was trying to give to in the first place. So we are about 590 contracts now. I haven't updated this. About $45 million in assets. So we are by far the largest independent CGA platform in the country, have about 350 referring charities as an example. So that's the National Gift Annuity Foundation. So these are the two primary entities that we use. And then sort of going across the top, I do virtual currency qualified appraisals as well as for life insurance appraisals and life insurance portfolio audits for charities, all this for a fee, hourly fee basis. We used to do a ton of these. I would do about 60 to 80 days out a year, about 220 to 240 CE presentations each year. That's pre-COVID. Still doing probably 3 to 5 a week now virtually, which has actually been pretty nice. Family's looking forward to me leaving again, by the way. I say that with love. So, Daddy, don't you have a trip planned coming up? No, not quite yet. So it'll be nice to get those back on. But in any event, things like this, so sort of free education and or paid speaking gigs for usually donors, board, staff, and professional advisors primarily. Charitable estate settlement. So we have Gary Sneerson is on staff, so an attorney that led Harvard's program for charitable estate settlement, illiquid gifts, and life income gifts for about 14 years. He's been with us, I think, about 6 years now, 6.5 years. So as those cases come up around charitable estate settlement, usually it's where they're super sticky. Maybe it's a foreign gift, maybe it's illiquid gifts, obviously, or something's getting a little bit sideways. Then he can usually get involved with his experience and hopefully help lubricate that process a little bit. A great quote I heard a long time ago from a colleague, and she said, charitable estate settlement's a lot like a kindergarten classroom. If the teacher leaves the room for very long, bad things start to happen very quickly. And so Gary's sort of our teacher in the room in that regard. And then while we're here today, I think, at least why I'm here today, charitable gift annuity risk management. It's as exciting and sexy as that sounds. So I'm an actuary by background, at least academically. We have 2 additional actuaries on staff, and we get all excited, strangely, around gift annuity liability management. So we have comprehensive audits. We've done maybe 350, 400 of those, basically actuarial stress testing of usually larger pools, 10 million or more, tends to work best with our models. We do, again, cash flow, financial modeling. And then what we're going to talk about today are really these last 3 points, and that is sort of larger concentrated risk analysis. Big one comes in, what do we do? Reinsurance is not code for risk management. It's one tactic for CGA risk management, one about 5 or 6, frankly. But in certain cases, reinsurance might work better. We're going to talk about some of those things today versus self-insurance. And then to the extent that it does, super conflict here, like off-the-chart conflict. I am an insurance agent, so now nobody will talk to me, I'm sure. And the only thing that I've ever done, at least since 1997, is reinsurance design and brokerage for charities. So I've never done life insurance policy or anything for individuals, nothing else. It's only this weird one-trick pony space of CGA reinsurance, both helping design policies for actual carriers. So I've been hired by 6 different carriers to design their contracts. And then I also do reinsurance brokerage, again, where that sort of fits. So super conflicted as we go through. Take everything I say with a grain of salt sort of seriously, just like you should take it with anybody else too. But we actually do design brokerage and placement for CGA reinsurance. So with that, we'll jump right in. I hope that wasn't too burdensome. So this is the agenda. So I'll go through this sort of quickly, and then I'll do another quick little housekeeping note before we jump in. So we're going to talk about CGA risk management overall, sort of an overview, talk more about how reinsurance is defined, what it is and what it isn't in terms of the risk transfer. You can see there are top 4 reinsurance applications. Let me see here. Whoop, jumped ahead too much. Trying to get my pointer. Here we go. Tax, accounting, and state regulation implications. Does it cost too much? That's always a question. It depends, right? Ideal carrier, to the extent that there is reinsurance being placed, sort of what do you look like in terms of the carrier and product? How does the insurance company and broker make money? Sort of what's in it for them, to be very clear and sort of unbundle some of that, which in some cases can be a little bit too transparent, I think. Opaque in that way. What characteristics, this is the big part, what characteristics make reinsurance more or less attractive? And so that's sort of when it works and when it doesn't, both from the donor's perspective as well as from the charity's perspective. And then I've included all these sort of ridiculous articles that we've written in the past 24 years. So have those all free, all on the website, download everything. So it goes from sort of the primer of like top 10 most frequently asked questions to, I think, 3, 4 articles that I've written with a PhD actuary sort of on specifically CGA reinsurance. So it goes fairly deep into modeling, we'll just say that. So a couple, again, number of people have just joined too. We do not make the slides available. This will be recorded. It's available for free on the Charitable Solutions website under resources and webinars. And the other thing is, if you could be so kind as to put any questions you have, I'll do my best to pause in the Q&A section. So the chat section gets quite bumpy for me to sort of jump back and forth. So if you put that in the Q&A section. And then I did this webinar last week as well. And so I'll take all the Q&As from last week's session, all the Q&As from this week's session, mush them. That's an actuarial term, by the way, mush them. And then I'll include that with the link that we'll send out to everybody who attends, or at least has registered today, including the link to the free recording and the combined Q&A document. So you'll be able to have sort of the full advantage of their questions as well. We'll see if your questions are better. We'll see. We'll do a little quick competition. So that's it. So I'll keep plugging along. So jumping right in, here we go. Risk Management 101. This is not specific to CGAs, but I'm going to sort of include some examples from a CGA perspective. So I have my graduate degree, which is also weird, in risk management and insurance. And the first thing you learn sort of day one is, what is risk? And risk is simply that actual outcomes are worse than expected. That's it. And then once you sort of say, well, what could happen, that where you'd have an actual outcome worse than expected, then the next question is how frequently? What's the probability that that will actually occur? So will it happen a lot or a little? And then the next question you try to quantify as best as possible is, how bad is it? So if that thing occurs based on that probability, how bad is it if it does occur? And so that's simply Risk Management 101. And then once you understand that, then you have 4 primary strategies to be able to mitigate risk. One is you say, well, I'll just retain it. So I will assume that risk. You do that in your personal lives through a deductible for your health insurance or auto or property. You're basically saying, I'm willing to take a loss up to the amount of my deductible. Anything over that, I don't want to bear that potential loss, and therefore I'm willing, based on these policies, to extend this, to actually transfer the risk. I'm going to pay, very important point, pay premiums, which in a weird way of thinking of it is a known loss of a known amount. I'm paying a premium every month to take away my unknown loss at an unknown amount above my deductible. You're transferring the frequency and more specifically the severity of that particular loss, whatever the risk is. Now, before you even get there, or even if you do transfer it, you might say, well, I've got this health insurance deductible, but I'm going to stop smoking. I'm going to start running, which, by the way, is horrible, so you want to do more walking, bad for your hips and joints. Anyway, I digress. I'm going to do things to either reduce the frequency of a bad thing occurring, or if it does occur, it would reduce the severity. So these are different strategies. Or you could say, not so much for health insurance, but let's say, I'm making this up on the fly, which is never a good thing to do. Let's say that I don't ever want to have aircraft insurance that if I were to pass away, sort of traveler's insurance. Well, I could avoid that by just not traveling. So there are certain levels of risk that inherently you can voluntarily take on, and if you take that on, now you have the risk. Or you can say, I choose not to do that thing, and therefore, for example, I will never die from skydiving. I am sure of that because I'm not going to skydive. I'm avoiding the potential issue. So it looks like we've got a little break here. Hopefully it'll pop right back up on the internet. Let's see. Let me jump back here. I'll kind of keep going. One thing, and I sort of have all this in my head anyway, but I'm going to go ahead and kind of get reconnected here. The other thing is not only do you have the risk retention, you have the risk reduction, you have the risk transfer, but you also have, and the avoidance, there are also sort of 3 primary tenets of risk management. And that is being able to, let's say, don't risk a lot to gain a little, don't risk more than you can afford to lose, and then knowing the odds. So those are things that to be able to think about any risk, forgetting gift annuities. And going back to gift annuities, let's say that from the 4 risk management strategies, one is retaining the risk. Actually, let me hop back on. Let's see. Zoom. relaunch it here right quick. Here we go. Here we go. Okay, I think I should be back in here in a second. So for gift annuities, as an example, retaining the risk simply means that'd be self-insuring. So you're self-insuring the risk as you go. The next piece is, let's see here, you guys can hopefully see me now and see my screen. Maybe give me another little hands up just in case that's occurring. Yes, good. So sorry about that. Gotta love the internet during webinars. Thank you very much for raising your hand there. Good shape. So you should see that in the screen. So 3 rules to remember: don't risk a lot to gain a little. Don't risk more than you can afford to lose, and know the odds. So going back here to risk management strategies, retaining the risk, that'd be self-insuring your CGA pool. Reducing your risk might be lowering the maximum CGA amount, lowering the maximum ages, as an example, reducing the ACGA rate. All those things would actually reduce your overall risk. Transferring, which is what we're going to talk about today, is gift annuity reinsurance. We're going to talk about that on the next slide. The point is, and this is so important, it's just one of the strategies overall. That's not code for, oh, gift annuity risk management means reinsure. I will also say, and I've got some good friends on the phone here from the insurance industry. I've got some good friends on the phone here from the investment industry. This is just me talking, and again, I'm conflicted. In many cases, I will see where an investment person would say, oh, no, you never need to reinsure because we can manage all this through investment allocation, so asset allocation on the pool. I don't think that's true, but I get it. Or you talk to an insurance person. Insurance person sees risk sometimes everywhere, and it's like, reinsure everything. It's like, no, we don't need to go not so that way either, in my view, generally speaking. And so there's a balance really between the two. What are some of those risks that can be managed very well through asset allocation, other risk reduction strategies that work quite well in the self-insurance portfolio for a CGA pool? And then there's certain ones that say, we are just not able to manage that risk enough, and therefore it might mean that we would then reinsure some of the gift. So when we talk about reinsurance, what does that mean? So here's what it is. So we have gift annuity reinsurance, and you can see here in all yellow, it's just a financing technique. That's all it is. It's only financing a liability. So important to understand. The same contracts in many cases that are used in the gift annuity reinsurance space are the exact type products used in the defined benefit pension plan space. So if you care, you might Google de-risking a pension plan. And that's code for the corporation with all these retirees that they have a corporate liability to pay the pensioners the retirement income, almost always for life, that they have the same corporate liability managing their own mortality and investment risk for that obligation. Sounds a lot like a gift annuity, doesn't it? And so GM, as an example, Verizon, as an example, took billion-dollar blocks of those liabilities, and they would turn to insurance companies, which they did, and said, hey, insurance companies, we don't want this mortality risk. We don't want this investment risk. How much do we have to pay you to de-risk, to insure this liability, this obligation that we have? And then the insurance companies come back and they say, for these characteristics of your pool, for these payouts, it's going to be X dollars and billions. And in many cases, certainly GM and Verizon and many others have said, yeah, that we're willing to do that. We're going to pay that premium. Now you guys deal with the mortality and investment risk, because I'm making this up. If I'm GM and if I sell a whole bunch more cars or trucks this quarter, but my earnings go down because there's been an actuarial adjustment on the pension obligation, that's not good for shareholders. Like, we're having a great quarter because we're charged with selling cars and trucks. But even if we do that, because this pension obligation has some whip to what our earnings are, we want to immunize ourselves against that whip. And so the point here is, if you ever hear about an insured defined benefit or just general an insured pension plan, that's what that's code for. Why am I making this such a big deal? That's not reinsurance, and this is not gift annuity reinsurance. It's just a term that has been used in the charitable space for probably 30 years now, ever since I got in 1993, where it's saying we have an obligation, a corporate obligation as a charity, for this liability, for this annuity, and insurance company, we need you to have bids then what to do to take that over so we don't have the liability and the risk that it otherwise could be an exhausted gift annuity at some point in time. Why is this important? So here we're going to go through a little flow chart. It's as simple as this. So I'm so cheap, I will not pay for clip art. Does it not look like he just said, I think I had or she said, I had an affair with your best friend during the war. It's like, what? So he looks really mad. But we're going to imagine he's a happy donor because I'm too cheap to pay for clip art. So this is the best one I could find. So here we go. So only he, because he's mad at her, right? He's mad at her. He's going to do his own gift annuity, a single gift annuity. He wants to do $100,000. He's 80. The current ACG rate is 6.5%. So he does that with the charity. The charity at this point could say, we're fine. We're going to self-insure it, put it into our pool, make the obligation. But there could be a series of characteristics where the charity might say, we don't want to do that one. What would it look like if we reinsured the gift? So that would be, in this case, let me find my pointer again, pointer, that the charity would come back and say, hey, insurance companies, he's 80, he wants a quarterly payment, I'm making this up, 6.5%, as long as he lives. How much would that cost? And this is an actual number, which I will show you live today. A $60,000 annuity premium is what would be required to 100% match the liability of $6,500 made payable to him every year. So it perfectly matches. It becomes an asset, the annuity contract, all fixed income, that exactly matches the annuity, the gift annuity liability. So they would say, okay, we'll pay you $60,000 insurance company, and then you're going to give us $6,500 a year. Think about it this way. It's very weird. The most actuarially positive thing that could occur if they self-insure it, this sounds horrible, but I'm going to say it anyway. The best thing that could happen is if he dies 10 minutes after he signs a gift annuity contract. That's horrible to say if they self-insure it. As soon as they reinsure it, now they're saying, I hope you take your vitamins, I hope you're on the treadmill, I hope you live until you're 127 years old, because now you're just going to sink the insurance company. Sink them. Go after the insurance company. So the point here is it completely inverses the dynamic between mortality risk. And most importantly, the charity, if they pay $60,000 to the insurance company and it was a $100,000 gift, the $40,000 is available for immediate use, either by the charity or the donor may wish to see it used immediately, or what most all of our clients do is they invest that $40,000 all equity, 100% equity, all equity, because the 60% is all fixed. And this doesn't just work out this way miraculously. The ACGA model portfolio for rate construction is 40% equity, 60% fixed. That's not just through happenstance. So in this case, you're in essence bifurcating the equity portion and the fixed portion, and then you're just letting this grow until life expectancy, all equity, because there's no payment obligation from that side account. That's what we're going to be calling it as we go through. So that's how it works. It's as simple as that. So let's go through. I'm going to go through a couple more, and any questions you have, again, just put it in the Q&A, and I'll do my best to sort of pick those up as I go. So what risk is transferred, what risk isn't? So the longevity risk, obviously, here is transferred. So the risk that donors will live past life expectancy, I already talked about that, and the investment risk. Twofold on investment risk. Very important to understand this, too. One is that the average return that is assumed on ACGA rate construction is met. That's sort of the first risk, that it's not met. Again, future outcomes or actual outcomes deviate from those that are expected. That's risk. But most importantly, this is lost on so many charities, most importantly, early return risk. It's called a sequence of return risk, is crazy sensitive in the gift annuity world. If you tell me how the first 24 months of investment experience is on a gift annuity, I will tell you how that whole thing will play out. If you did a gift annuity in 2007 before the 2008 fund, those are toast. Toast, toast. You cannot ever take early losses in the first 24 months on a gift annuity. Ever, because you're making a fixed payout based on the original gift. And when the original gift goes down 10% or 20% and you're making that fixed payout on the original amount, that creates negative compounding. Bad, bad, bad. The only hope is a super early death. That is the only hope. Conversely, if you would have done that same gift annuity in March of 2009 at the low point of the market, 18 meteors could hit that thing and you're good. There's nothing. She could live until she's 130. You're good. If you have this blast out of the gate, there's almost no way to eat into that immediate surplus. But they are crazy sensitive to early returns and volatility of early returns. Why I bring this up too is we usually see a very, very high correlation of big gift annuities coming in at the top, like now, of the bull markets. And so these big, it's called adverse or anti-timing. So when those come in at the peak of the bull market, they're then sold, taking equity risk, converting that to fixed guaranteed income, taking the deduction, no recognition of capital gains, all the good stuff that you know so well. That works great, unless then that is actually the peak of the market and then it starts to go down and now you're sort of stuck. That's the problem. But those are all transferred to the insurance company. If the insurance company defaults, and I put this right in here, and another company doesn't come in, and state guarantee funds aren't there, and there's not liquidation of assets, then the charity still remains contractually liable to make the payments because it's the charity's contract with the annuitant that is the guaranteed obligation, backed by all of the assets of the charity, typically unrestricted more technically. And this, again, is a way of financing that obligation. The charity could take the $100,000 and put it in Japanese yen or a Vanguard Balanced Index fund. The charity can do whatever they want. Now, they're prudent things to do, my point, but they could also say we'd like to basically transfer the risk for the mortality and investment to the insurance company. And this is so important. This is really how reinsurance is defined. Reinsurance provides a known amount at a known point in time, bifurcating the present value of the charitable remainder interest and the present value of the life income interest. It bifurcates that on day one or whenever it's reinsured. Self-insurance provides an unknown amount at an unknown point in time. Could be more, could be less, but it's unknown. That's it. That's the difference. So I think there's a question here. Let me take a quick look here. So the contract with the insurance company becomes an asset owned by the CJ pool. Yes. Great. It is an asset. And most importantly, this is interesting, and we'll talk about this on the next slide, that the asset value always precisely to the penny matches whatever liability calculation is being used. So if you're doing your FASB report for 106 and 107 for accounting for split interest gifts, whatever assumptions are used for that to determine the liability, then the reinsurance asset contract is exactly the same asset value. It's always a perfect match. What happens when you go to California and look at their assumed liability calculation? Then you would calculate that liability, and then this asset exactly matches that, or New York or anywhere else. Now, I would also say, and you'll see, that most every state allows for a full reduction in the reserve requirement for any gift annuities. But my point is, if you're using different assumptions to determine different liabilities, the asset will always precisely match, called asset liability matching or ALM, for that liability obligation. Yeah, so great question. All right, so we're getting right into this now. So next one is the top 4 uses. And so number 1, manage concentrated risk. So when these come in, if they're really big is bad. And so relative to the pool, it doesn't take an actuary to figure out, well, we got one that's 15,000, one that's 26,000, one that's 18,000, one that's 1.2 million. You're like, whoa, how'd that big one get in there? So we usually look real rough rules of thumb. If it's 7 to 10 times larger than your average gift annuity, that might be something to look at, not so much for reinsurance, but for risk mitigation. There might be some other things to do first. So that would be a concentrated risk. The second one is an investment alternative for fixed income. So I'll talk about this a little bit in a moment. So we'll talk about this on the next slide. Mitigating reserve requirements. So if you have, as an example, a New York qualified reinsurance contract, as an example, then you don't have to put in the extra 15% and then the extra 10% on top of that, making it 126.5% full reserve. They actually back out the entire liability relative to the reserve requirements. So all those extra reserves are not required to do that. And then money now, which can be good or bad. There are certain places like, look, we're using these to build our endowment. We've got one of the charities, we're with about 250 charities around gift annuity reinsurance. I think we did, I don't know, maybe 150, 200 contracts last year-ish, reinsurance contracts. The largest one we did last year was a $17 million gift annuity. Working on one right now that's $26 million gift annuity. These are coming in really, really, really big, because people all figured out after the late 90s that CRATs, charitable remainder annuity trusts, exhaust. Same issue with early, God forbid, flat or even worse, losses. That is not good. So now many attorneys used to be, when I got in this field, it was if it's less than $250,000, do a gift annuity. If it's fixed, do a charitable remainder annuity trust. Many attorneys are saying, no, you do a gift annuity because that can't exhaust. Well, then that shifts all the risk over to the charity, obviously. So some of these coming on are gigantic. Biggest one I've ever completed was a $28 million one. Testamentary gift annuity for 2 daughters. We had to use seven insurance carriers to reinsure those. It was way, way too big even for these billion-dollar pools to be able to provide risk management within their pools as well. So money now, getting back to this point, is either the charity or the donor wishes to see the money having impact now. And of the couple hundred charities that we do this for, I think there are 6 that really view this almost like a major gift vehicle. So really what that means is there's one group, it's an environmental group, they said we are not about endowment. We have a bay, and we're protecting our bay. And if we build endowment for 25, 30 years, meanwhile the bay is being polluted now, that's not good. So we are using gift annuities as a way to free up after reinsurance and then immediately deploying, and then my hypothetical, the $40,000 for bay mitigation in terms of pollution or reduction in that way. So they're really using it in that way for their own mission. And there are a number of religious organizations doing the same thing. So it's basically kind of put it into the kingdom now versus trying to wait a long time, as an example. So each one has a different perspective about whether that works or not. Now, one came in the chat. I want to say, so is the default, this is from the last slide, is the default potential the reason why we would not want to put the $40,000 in a donor advised fund now or designated fund immediately making grants? You can definitely do that. Now, there is a risk that it potentially could happen. No annuity, immediate annuity, forget gift annuities, no immediate annuity in the history of our country, and I've done massive research into this, in the history of our country has ever defaulted, ever. A number, probably a bunch, of insurance companies have gone under, but what they tend to do is they penalize younger insureds because they have more time to make it up. This is sort of the widows and orphan side. Immediate annuity typically means they're older and they're getting a fixed guaranteed payout. Every court so far, it could change, I have no idea, but in the history of our country, none of those have ever defaulted. They could, but I don't have any charities holding back some kind of reserve for that contingency. But there's no, and the other question is there a legal reason that you would not want to transfer funds to the donor's fund during their lives? No. So we actually have, and this came from a community foundation in the Northeast. We have a number, we did one in the Southeast 2 years ago, and it was a $700,000 gift annuity. They reinsured that, and they took half of what was left over, the $40,000 in my example, and put half into an unrestricted fund and half into a non-endowed donor advised fund. Donors were so happy because they said, we're seeing the money being used now. I didn't even know this was available. I'm not saying that's the right thing to do. That's for those donors' goals, but that sort of goes to the specific question. Another one here, it looks like, so reinsurance advantage over fixed income tailored portfolio is an exact match to liability, not just good or close match. Exactly right. The other thing, and I'll go through this on the next slide, And that is, and this gets a little bit funky, but in 2006, our firm was hired to do a mortality table, build a mortality table for gift annuitants for the Society of Actuaries. So we received a research grant to do that. So we did that. It's all free. It's on our website, wherever you can take a look. So it's about 38 pages of statistics that at the end, the final conclusion was they live forever. And everybody on this call knows that. Everybody, probably half of you are laughing. Actuaries don't laugh. So when I was going through graduate school and I was working for a charity full-time as their plan giving director, and everybody would say that, oh, do a gift and we live forever, and they would all laugh every time. They were all the development people laughing every time. Never the finance people laughing, ever. And I started thinking, has anybody ever looked at this? That may not be so funny if, in essence, you're mispricing the policies, mispricing the gift annuities. So, super long story short, we could never figure out who did the research grant. So we did the thing. It's published, Society of Actuaries, blah, blah, blah. They live forever. We took 36,000 annuitants, 10 exposure years, 28 different charities, blah, blah, blah. Did this massive table, and they live forever. When I say forever, there's 178 cohort life expectancy tables or population tables for the Society of Actuaries. This group lived longer than they've ever seen. And we all know why. Even if they can do $20,000 gift annuity, they're probably going to be in the top 1% socioeconomic profile in the country. They're wealthy. They are only doing the gift based on their life expectancy. They're healthy, and they're doing it voluntarily at a very advanced age, 78. Those three things make an actuary sweat. That's called adverse selection. And so where I'm going with this is we finally figured out it was a life insurance carrier, it was Hartford, who funded the program. And as soon as they got that release, they said, we are out of the gift annuity business. We thought this was occurring. We had a pretty good block of these. We couldn't figure out why they were living so long. We're mispricing all of this because we're pricing this as if they were a normal population. They are not. And so, Matt, I won't say your last name, the question around reinsurance then becomes this fixed income alternative, but it has a longer life expectancy than what most insurance companies think. And so if you came in off the street, they would give you a reinsurance, an immediate annuity price, or if you were a donor to a charity with all of these other positive attributes, it's the same price. So there's mispricing that creates a bit more of an internal rate of return over what fixed income allocation would otherwise be in the aggregate. So great question. All right, let me get out of these, get out of here. Okay, so what are the implications? I'm going to go through this one really quickly. There aren't any. Everybody says, oh, if you reinsure, the taxes in. No, taxes don't do it. As long as the charity does not require the purchase of reinsurance, and I've never seen that in my 27 years of doing this, never seen anybody do it, there's no reason to require it. A typical CGA policy might say something along the lines of, from time to time, we may is a very important word, may choose to reinsure some or all of a gift annuity obligation or liability to the extent that we think it is prudent. Ta-da! That's it. And so you may do it, you may not. And so to the extent that there's the may, conditional, not required, all the 1099 is the same, the deduction is the same, the FASB calculations are the same, all of this is the same. And the person who asked the question before about how it relates to the asset liability match, you can see it right here. You'd calculate the FASB liability first, and then whatever that number is, that becomes the asset value, contract value, inside the CGA pool. That's it. Which then again, in every state, you can see here at the bottom, can then be reduced because they basically are concerned. Insurance commissioners are concerned, or departments are concerned about, there's these kind of crazy charities out there, and all of a sudden they're taking these big annuities, and they kind of look like a life insurance company, and they're kind of not a life insurance company, and we need to protect our consumers. So instead, they would say, listen, if you go out to a billion-dollar carrier and you transfer the risk to them, we're basically saying, okay, now we're not as concerned. And many of you may know, Illinois is an example. If you don't have $2 million of unrestricted assets and 20 years of existence, they require gift annuity reinsurance. It's consumer protection. They don't want young, small charities issuing these things and then getting sideways. So went through that one pretty quickly, but nothing really changes. Here's another question I get all the time. It seems to cost too much. 60%. Oh, I get it. It's 60%, and the ACGA assumes 50%. Oh, I used to have so much hair until I've said this like 8,000 times. The ACGA model assumption is 50% of the original gift in the future. 78-year-old female is the average gift annuitant. Average life expectancy is 14 years. So 14 years from now, if they did $100,000, she did a $100,000 gift annuity, there'd be $50,000 left in 14 years. That's $20,035. So you can see where I'm going with this. It's not so much what will happen in the future. People comparing future values with current values, that's not good. That is apples to oranges to bananas. Versus in this case, that was a single male, which makes the reinsurance cost a little bit lower because it's a shortened life expectancy. But you can see that Charity had $40,000 left over, and that's a real number. You'll see that in a minute. And so the point is, they'd say, well, what would you do with the $40,000? You could use it currently, as I mentioned, or you could stick it all equity and just let it grow for 14 years. It would be more than the $50,000. I think you all could figure that out pretty fast at any kind of growth rate. So that becomes the question: is what would you do with it? You come up with your own assumptions. I think it would grow at this rate or that rate. I have no idea. If you guys can tell me what the investment growth rate is going to be within probably 10 or 15% deviation in the next year, we'll own an island somewhere if we can be sure of it. So I have no clue. But you can use some logical assumptions or perhaps past or going forward assumptions. And then you can see the yellow at the bottom. If we self-insure and model to life expectancy, what is the projected ending value? It's kind of like buying term and investing the difference is the best way to think about it. So here's an example. Now this got all messed up last week because when I went to a different screen share, nobody else saw it. So I'm going to need your hands and a little activity here because I got two places I want to go and then I'm going to jump back. So here's an actual case. This came up a month ago. And so it was an Arizona Community Foundation. They had an 80-year-old male, same one I used before, wants to do a $1 million gift annuity. So not $100,000, $1 million. His rate is 6.5%. You can look it up. Everything's the same. And the reinsurance premium is $600,000. So let me see if this works. It should be where I can jump here. It says I'm still screen sharing, so we will see. Come over here. Come here. So how about some hands? Can you guys see my screen? Yes. Look at there. It worked by some level of miracle. Okay. So this is basically a bid aggregation. Thank you very much for raising your hands, by the way. A bid aggregation tool. And so I use three different ones. This one's probably the best, frankly. And so you can see here, they're Arizona. Here's the birth date, January 17th, 1941. He's 80. He's male, single male. $65,000 a year. That's 6.5% annual for the gift annuity. Purchase date I made today because I was like, oh, you're gaming the dates. Here we go. So it's today. And then the start date would be March 23rd, 1 year from today. Okay? And it is life only because that's what the gift annuity. It exactly matches the gift annuity obligation. So here we go. Here are all the companies that bid. The best one was Minnesota Life, $592,000. They will not issue gift annuities. Absolute prohibition. Prudential will not issue gift annuities. I don't know if they read our report. I have no idea. They will not do it. New York Life will issue gift annuities in certain states. You can see then the single premium is $601,000. So when I say 60%, this is the number as of today, run today. That number moves every day. These other ones, Mass Mutual will not issue gift annuities. AIG will. I've never used these other ones. Penn will. Mutual of Omaha down here will. They're very active in the space too. This is MetLife. Used to be MetLife. Bright House Financial. Couple points. These are live quotes. These are bindable quotes. This is not magical stuff. But the point here is you can see $600,000, and the other one down here. These are all quite competitive in terms of carriers. $680,000. It's not like one's $12 off. There is massive deviation, massive between these different bids. And so getting a lot of bids is usually very helpful. And again, two other systems bring in a couple other carriers. So that's sort of the first thing. So then what I do, we're going to need your hands again. Can you all see? Let's see. I think can you see my screen still? I'm hoping. Good. Uh-oh, I see a whole lot of people in the chat. We're only seeing actual case start. Okay, let me see. You guys are just seeing the PowerPoint. So here we go. New share. Let's see here. You guys raised your hands. Okay, here we go. How about now? Can you see my screen now with this? It says CanX on the top left. Okay. Okay, now I know. Thank you. I've got to stop it and then share it again. So you can see here, all of this was what I talked about before. This is the full case. Here's the premium for each one of the carriers. Here's the $601,000 for New York Life. Here's the $680,000 for, used to be MetLife. So you can see all that stuff there. Okay. Now before, since you can see this screen, I want to share another thing. Let me see if I can go back here if it will like that. Okay. So I'm going to go back and I'm going to change this input to $200,000, so about roughly triple. So let's say it's a $3 million gift annuity, just to make one quick point. So we'll submit. It's calculating. Here we go. I hope you guys can still see the screen. So what happened to all these other carriers? They all drop off. There are a very, very small number of carriers that will do anything over $1 million, because it represents too much risk within their billion-dollar and beautifully smooth pools. Statistically, they're magical because they got so many homogeneous units in the pool that it creates too much concentration of risk. How? Let's go down here. Reasons for not quoting. AIG, premium over $1 million requires approval. Bright House, Met, premium calculated as too high. Too high. Guardian, too high. Mass Mutual, too high. They don't want to touch these at any price. But in many cases, we see charities doing $4 or $5 million gift annuities. We got 8 gift annuities. That sounds good. Like, oh, not good. Not good. Even these carriers won't take that. So let's go back. I think I'm going to stop sharing, and then I'm going to share again. And let's see. All right, I need your hands again. Does that work? Can you see the screen? Excellent. Okay, thank you very much. So this is a little tool. It's not perfect. We use some Monte Carlo and other stuff to make it a little bit more, but you'll get the gist. So this was for the Community Foundation. Same case we just did. So it's an 80-year-old male. He has a 10.72-year life expectancy. That's called the IAR table with a 1% improvement. Same table used by the ACGA. Current market value is $1 million. That's the gift annuity value. The insurance self-return net is 2.75. That's the ACGA current assumption. Gross is 3.75, assuming a net constant of 2.75. The immediate surplus net return, all equity, that's all it is, what's the side account, is at 8%. That is the ACGA assumption. The long-term equity assumption is 9%, less 1% for expenses. Everybody with it? Just following just those assumptions. They may not be your assumptions. You can change all those assumptions. You can do your own modeling. This is just sort of laying this out. And so the CGA payment is $65,000 a year. That's the 6.5% on the full million. The reinsurance premium, let's make it actual. We'll say $601,000 because that's what it was. It moved on me $1,000 in the last week. They move a lot, so that will be more accurate. Won't change anything. So year one, self-insured. Let's see what happens. So if you take that in, you would have 2.75% growth, everything constant. Then you'd have a payment of $65,000, and then it would drop to $962 at the end of year one. That'd be the self-insured model. So everybody's sort of following along. And then you sort of plunk along. You'll see why I did that yellow in a second. And look, 10.72 years is the life expectancy. Here we are at 11 years, basically that. And the original gift was $1 million, and this is $525,000. So this almost perfectly matches all the ACGA assumptions of having 50% of the original gift in the future at life expectancy, assuming the donor dies the moment he's supposed to die. And you get 2.75% net constant perfectly every single year. If all those assumptions hold, you can see there it's exactly where we're ending up at $525,000. Okay? Again, this is not perfect, but it sort of gives you an idea. What if you reinsured the entire amount? Mathematically, sometimes it's not good to do that, but that's a webinar for a different day. So in this case, what do you start with? You've given $601,000 to the insurance company to reinsure the whole liability. All the payments are now made by the annuity reinsurance contract. So that only leaves you with $399. In year one, at 8% growth, assuming all equity, because the annuity again is all fixed, $31,000 would grow. Now you have $430. You can see where you go. Then $430 is the next one for beginning of period 2. It grows by 8%, plunk, 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 plunk. And now here we are in year 8. Remember, year roughly 11 was life expectancy. In year 8, you have the crossover. You have where the side account has now caught and passed self-insured account under these assumptions. So it passes it by a good bit by year 8. So that's 3 years prior to life expectancy. In every actuarial model we've done since 1997, it's always 2 to 3 years prior to life expectancy is where you have your crossover. What does that mean? If that person dies in year 2, bad move, not smart. You would have had $923,000. Now you only have $465. Bad. The person lives to 3 years prior to life expectancy. Good. They live to life expectancy. Really, really good. So you can see here this drops to $525 while this increases to $930. So that is sort of it's linear. It's a linear model. And then we do this little fancy thing here at the bottom where we show a little graph, and you can see here a whole lot bigger when you start by self-insurance, but then that's coming down as the other one is going up. Year 7.5-ish is where you've got your crossover, and then the longer the donor lives, the better it gets, super spread. Now, this donor didn't live in 30 years, I'll tell you that, but you can sort of see how that works. Not saying it's right, but that's just how it models. So let me do a quick little stop share. See if I can then do a reshare. Hopefully we'll get my screen back. Dun, dun, dun. Okay, all good with hands again? Couple hands, some hands. Oh, thank you, thank you, thank you. I appreciate the participation. So here's the actual case. We just did the actual live bid. The older they are, the lower the premium. Males better than females, etc. More risk on the female side. But you can see the summary. Side account crossover is about 3 years prior to life expectancy, consistent every study we've ever done. Final reinsurance side account is about double that of self-insurance at life expectancy. Not saying to do it. And I want to be so clear. We look at huge pools. We do this actual modeling with huge pools, 500,000 annuitants. We usually recommend reinsuring about 1% of the pool. The big ones. We did one, I think maybe June of last year, had about 610 annuities. We recommended reinsuring 4. 3 of the 4 full insurance. 1 of them we did what we say partial insurance, basically taking just the fixed income allocation, using that for the reinsurance. Mathematically, that tends to be where it's optimized. So we've done some papers on that too. Anyway, so that's a real case, one I'm working on right now. I thought that might be helpful. So how does everybody make their money? The insurance company knows how long the person's going to live because they have thousands, in fact, sometimes millions of annuitants, which creates law of large numbers, which smooths everything. It is so magical and enjoyable, and we get all excited as actuaries when you see that. So then now they don't have really any mortality risk. If somebody dies the first day, they then take that, it's called a mortality gain, by the way, and they reserve that gain for the same person within this huge pool that will live that much further past life expectancy. So then all now they have to do is to match duration of what their payments are going to be. So let's say that they got $600,000. Let's say New York Life got $601,000 tomorrow. What they would do, I'm really oversimplifying this, but they would go into the institutional fixed income marketplace, bonds and mortgages. They have about 2% invested in equity. It's all fixed. And they would say, we want to buy a fixed income tranche, a bucket, with about an 11-year life expectancy, 11-year duration of payments. And they lock that in, I'm making this up, at 5%, probably it's not going to be that high, and then they'll credit the annuity back with 4%, and they're making that spread. That's where they're making their money. A couple other places too, but that's primarily, it's the spread. What they can do with the fixed income marketplace now that they've immunized their longevity risk. Where a broker makes, me, Where I make my money is on the premium. There's a commission. The commission is paid by the insurance company. You're still paying it indirectly. But the $601,000 for New York Life, that already has a commission in there of 4%. It's 3% for the agent, 1% for the general agent or the master broker. I am both for them. Any New York Life agent can sell the same policy, nothing magical about it, and it's all 4%. Most every carrier, it's baked in at 4%. So that's where the broker makes it. It's a one-time upfront, not complaining. There are no trails or anything else. 4% upfront comes right out of the premium. So that's it. That's how they make the money. Ideal characteristics for the carrier, better ratings, the better. So I've included all of this stuff. I'm not going to go through all this too. There's some that have a dedicated gift annuity product line. Sometimes they'll do 1099s that are compliant. Some of those things too. I am a big fan of having the charity as the owner of the contract, which they have to be, the payor and the payee. So when you get that $65,000 a year for this annuitant, then it's coming into your bank account, and maybe that's at some third-party administrator, you're doing it internally, but then when you're cutting that check or doing that direct deposit, it's coming from your account. It's simply just a way of financing that liability. That's it. So it's a way to continue to show that the contract is between the annuitant and the charity. And you can see the rest of these. Now, here's the big point. I've got a little bit over because I had that little internet snafu. I'm sorry here, but this is the most important point. This is pretty simple, but very, very important. When does it work? When does it attractive versus unattractive? And you can see here, donor, and gift characteristics that make it most attractive. Older donors, 80 to 85 sweet spot. Many carriers at 86 will not issue the gift annuity at any price. It creates too much longevity risk for them. So 80 to 85, good, very good. Healthy donors. If she's calling you from the Hawaii Senior Triathlon Olympics for the 5th year in a row with her gold medal, reinsure. If she's super crazy healthy, that's not the risk that you want to take on. And again, the insurance companies are not able to determine that. There's no medical underwriting at all. They're just doing it directly. Immediate annuities better than deferred. Female donors, large gifts, concentrated gifts relative to the pool. Donors who wish to see the money work immediately. And restricted gifts. So we see this all the time with large faith-based foundations, community foundations, universities. The second you have a restricted gift, that changes all of the risks. It's called risk asymmetry. If you have 100 restricted CGAs, restricted by fund agreement, you do not have a pool for loss sharing purposes. You have 100 one-person pools. Totally changes the risk dynamic. Very importantly, if all of these things have the converse, it makes it less attractive. Younger donors, unhealthy donors, deferred, male, small gifts relative to the pool. They don't care if they see it used immediately. Whoop, I jumped ahead. Don't care if it's used immediately. And unrestricted. Those all make reinsurance less attractive. The next point is, how about for the charity's point of view? New or smaller pools. The charity might want to use some of the money immediately. They want the least amount of administration possible. It doesn't take away that much, but it takes away a little bit. Charity is organizationally risk averse. I've had a number of charities come and say, Brian, we can never take a dollar loss on any of these ever. Bad things would happen. Like, then the only thing you can do basically is to reinsure. Or avoid the risk, don't issue gift annuities. Or refer your gift annuities to a community foundation or National Gift Annuity Foundation or some other group. So that's another way of avoiding the risk. Or financial modeling, here's my pointer, financial modeling that projects higher ending balances under reinsurance versus self-insurance. So what I just did on the little Excel spreadsheet. The charity wants to back out of state reserve liabilities. I hate using it for this way, but we did a lot of reinsurance placement, primarily New York in 2008, 9, and 10, when there were some major capital calls where charities like, we cannot put more money into this, back us out on the reserve side. Or there are no excess reserves or unrestricted money if something goes negative. If something goes negative, if that creates real bad things, don't take that in and then hope for the best. Again, the converse of any of these characteristics make it less attractive. Older, larger pools, they don't want to use the money immediately. They don't really mind that much on the administration. They're risk tolerant. You get the rest of this. So this is where, from the donor gift perspective and the charity's perspective, where it fits and where it doesn't. And the final slide, you're so happy about the final slide. These are all of the crazy articles, again, all free. I talk about resources and webinars for where this link will be. If you go to resources and articles, all these are there, are all linked. But you can see 1998 was the very first one we did based on research done in 97. And then we've done all these other sort of crazy ones since then. So this is all around sort of where it can work. This is risk management more broadly, and then there's some things that are very specific to reinsurance. So I think there are a number of questions. I'm going to answer some of those. I hope this has been helpful. Again, if you talk with this is bad. If you talk with an insurance person, it's like, insure everything. Talk with an investment person, don't insure anything. There's a balance. I would respectfully suggest. I'm conflicted because I'm the insurance guy in that scenario. But if you take in a really big one, if the donor or the charity want to use the money currently, if you're risk averse as a charity, in some cases donors are coming to charities going, look, I love you, charity, but we went through 2008 and 2009. I want $1 billion carrier backing this thing and you for the size of this gift annuity. So some donors are actually now becoming astute about what that guarantor or creditor risk otherwise would be too. So I hope this is helpful. I am going to stay on. You guys want to drop off, that's fine. I'll answer some of the questions though now, and then I will definitely answer them in the Q&A and the email that I sent out probably the next 2-3 days with this recording. So thank you all so much for attending here, and like I said, this will sort of close the more traditional part, and I'm going to jump over here to the Q&A. So what does NGA do, maybe NGAF, with the dollars over and above premium when they reinsure, add it to your pool? So yes, when we do reinsurance, we add, we basically have that all equity. So we keep it out of the core pool, which for us is 40% equity, 60%, 55% fixed, 5% cash. So we match exactly the ACGA assumptions, but that's what we do. Or we just go ahead and pay it out directly. So we can have a program where we pay it out immediately too, so once that's done. Cannot see the chart, cannot see PowerPoint, so yes, thank you for that. Oh, that's almost all of these. Oh, so in California, I've heard that only one character is allowed to reinsure CGA's Mutual of Omaha. Yes, so I worked with them to sort of get that done. That's the only one that I'm aware of. That one gets very, very interesting, more of a discussion offline, that technically we don't even know if they've been fully approved to do that, although their group retirement income contract was specifically designed to meet the specific provisions within the insurance code for California to qualify. But that's a sort of an interesting question for another day. Yeah, I think that's it. Well, perfect. Well, I think all these were just, I was having trouble on the internet sharing the screen. So again, thank you so much for attending. I hope everything, this has been helpful. And by the way, for those of you who are still here, we're going to do a really cool webinar next month. You'll get a blast email, but I haven't exactly come up with the best title yet, but it's something like New Frontiers in Charitable Giving. We're going to talk about SPACs, PIPEs, and NFTs. So the special purpose acquisition companies, PIPEs, which is private investment in public equity, and NFTs, which are non-fungible tokens. You saw Jack Dorsey just sold his first tweet for $2.9 million and is going to give all the proceeds to charity. So I immediately thought, why wouldn't he give the NFT to charity first? So that will be the webinar for next month. So again, hope this is helpful. Thanks for your time, and wish you the best of luck. Bye-bye.